So hello everyone in my MBA 502 class, and I do hope everyone is doing okay. And as you know, I pushed the midterm way ahead again because of these problems. I hope we don't have any more problems with my finance lab. But I think we all should monitor it and go on occasionally, do the homeworks, and I'll be on there, see if it's still working. Okay, anyway, I'm going to do some stuff here for Chapter 10. And Chapter 10 is with regards to risk. So we'll be talking a lot about risk in this chapter, and the equations, unfortunately, the equations will be coming at us hot and heavy. Now, I just want to make a point. 10.5, I'm not going to cover 10.5, okay? So I'm going to skip it. So all you got to do is know 10.4 and 10.6 for the final exam, okay? So that's all you got to know. And 10.5 we will skip. Okay, so we're going to look at risk and return, and how do we measure risk and return, and a lot of historical risk and return numbers here. And as I said, we'll skip 10.5, and then we'll finally talk about beta, right? Every stock has a beta, and when you buy a stock, you should look at the beta and see how it is. Okay, and then infamous probability is going to kick in this chapter. Mean variance, standard deviation. I don't know if you people ever had any of that. And we'll talk about volatility. And I guess then eventually we'll try to get the total return. So like I said, the equations are going to be coming at us hot and heavy here. So again, I'll split these up into like 10-minute chunks, all right? Please make sure you read this chapter. It's got a lot of content. Okay, we're going to look at systematic and unsystematic risk too. Okay, systematic risk is kind of just what we're dealing with now with the coronavirus, right? The complete system is affected, and we can't diversify out of it. Idiosyncratic is undiversified, and as you saw with my portfolio, I lost about $500,000, and there was nothing I could have really done about it, right? The whole market dropped down. It was systemic. If I could have, if it was just a few companies and I was diversified, it would be a big difference, right? So we're going to look at an efficient portfolio and a market portfolio and all this stuff. And I'll define the capital asset pricing model, which will make great use of beta. The capital asset pricing model is going to tell us how much return we should expect on a stock, only based on systemic risk, not on the idiosyncratic or diversifiable risk, right? So we'll use the capital asset pricing model, right? And we'll look at efficient markets and why the cost of capital depends on the systemic risk, rather than the idiosyncratic or diversifiable risk, all right? So anyway, there's 100 slides here, as I said. So, okay, so looking at a little history, which is really worth looking at, because the market, we just got through the most ugliest market in stock market history since 1987. The market, I think, was down almost 12% for the month. So personally, I'm glad March is over for a lot of reasons, right? So the question is, how much would $100 have grown if it were placed in one of the following investments? Standard & Poor's 500. And there was 90 stocks in there. And then after 1957, they had 500, right? And if you had it in the small stocks, how much would it have grown? So the question is, of these two, how would your money have grown if you would have to put $100? And actually, 100,000 would be a lot more like it. You wouldn't be working today. So here's these other investments, right? You can look at an international portfolio, and you can look at how much would have grown with corporate bonds, and also with treasury bills, right, which are risk-free. So they look at 3 months. So don't expect to get rich off investing in treasury bills, right? 3-month securities. So I don't know if they should show us the rate here, right? So here's the chart that we were just talking about. And here's the $100 in 1925. So if you look at the red graph, that's small stocks, right? And you can see early on in life, small stocks really did not do well, right? But over time, small stocks outpaced everybody. And $100 today, you would have had almost $6 million, right? And the S&P 500, you notice you would have almost 10 times less, right? Considerably less. And so, you know, that goes that. And treasury bills are the green. Interesting, if you would have had $100 in 1925, you'd only have $2,000 today, right? If you had your money in treasury bills. This points out why you want to have money in stocks, right? At least here and here. So small stocks give you the best. So anyway, it's an interesting table. It's an interesting table. Even bonds, you know, you don't want to have all of your money in bonds, right? Bonds are important when as part of an overall portfolio, as part of your pie chart. So here you can see small stocks had the highest long-term returns, and T-bills had the lowest. So few people ever make an investment over 92 years, but there are some people who did. People who handed money down from, you know, generation to generation. I wish somebody would have done that for me, but nobody did. So that's the way that went. Okay, so here's the value of $100 invested in different investment for differing horizons, right? So these are small stocks, S&P 500, corporate bonds, and treasury bills. This is what you would have got over 1 year, right? So this is this year you would have did really well with small stocks in 1935, but you can see it all depended on the return each year. So this was the value after 1 year, right? So if you would have invested $100, let's say, in this year, just for 1 year, you would have got that return. So you can see after 1 year, it varies. It varies. So this was just before the crash, right? And here is the value after 5 years. And you can clearly see now small stocks start taking over after 20 years, right? They start surpassing everything else. These are great websites. You should you know, go visit these websites. So here's the value after 10 years. All right, so you knew it was coming. We had to talk about probability distributions, right? So based on when an investment is risky, it may earn different returns, right? And except for treasuries, almost all investments are risky, as you can see by mine, right? So each possible return has some likelihood of occurring. And so there's this thing called probability, which a probability distribution, like a normal distribution. And this is going to assign a probability that each possible return will occur, right? Now, the important thing is, how is that determined? How do you give it a return a probability, right? All right, so assume BFI stock currently trades for $100 per share. So in 1 year, there's a 25% chance that the share price will be 140, a 50% chance it will be 110, and a 25% chance it will be $80. So All right, so basically, these are the three probabilities associated with three different prices for $100. Okay, so here is the theoretical price, right, in 1 year. Here's your original investment. Here is the probability of, here's your probability, right, the three probabilities, and here's the return. So if it's up by 40%, you would have 140, right? If it's up by 10, you'd have 110, and if it drops by 20, obviously you've got $80. Okay, that's how this is all determined. If you have any questions about the math, let me know. So if you draw it out on a graph, this is what it looks like, right? Your expected return is 10 or 40 or minus 20 with these probabilities. Okay? All right, so here's the equation for expected or mean return, and here's how we calculate it. You take those three numbers, and this means sum. See sum, sigma? This means sum. You take the probability, multiply it by the return associated with it, and this is expected return, and you'll get 25 times minus 20 plus 50 times 0.1 plus 25 times 0.4, and that'll give you 10%. Okay. All right, so I'll pick this up in part 2. I'm almost 12 minutes into this.